So the US debt deal may be done, but the data coming out of the most of the developed world does not make for comfortable reading. Add to that simmering problems of Europe's debt crisis and questions about the sustainability of China's growth, and it's no wonder markets are skittish and investors nervous. Well, I'm joined now from London by George Magnus, Senior Economic Advisor at UBS Investment Bank. We've got a few problems with our London studio, so he's actually on the phone. George Magnus, welcome to the programme.
Thank you very much.
Now, a Satan sandwich, according to one Democrat today. Is that what you make of this compromise in the US?
Yes, I think I do, actually. And I think it's not a particularly good political deal, and it's certainly a very bad economic deal. I mean, obviously, against the alternative, which might have been for the United States to end up in default, either not paying interest on its coupon on its interest or in defaulting its citizens, obviously would have been a very, very bad situation. But I think that this arrangement actually is bad politics. It doesn't really, effectively, it allows the U.S. government to completely abdicate from the whole process of fiscal and budgetary management and tax reform and so on, and means that this is all happening at a time when the U.S. economy has already slowed to stall speed. So I don't feel this is a particularly good deal, and the rejoicing, I think, is very, very weak.
Now, do you think a credit downgrade is inevitable?
I think it's pretty likely that this will happen, if not immediately, then in the not-too-distant future. One of the things which the credit rating agencies really kind of care about is growth. And the United States economy doesn't have very much growth, and it's not likely to get very much more as a consequence of this debt ceiling package as well. So my feeling is that there will be a downgrade. I don't think it's at the end of the world for all practical purposes, because investors still require the liquidity which only the American bond market can provide. And the US dollar, while weak, will still be the world's reserve currency for a long time. But it deals a huge blow to America's prestige and its authority in the world, when we really need American leadership at a time of great economic unrest, in not just in the United States, but in Europe and in possibly in the next couple of years in China as well.
Well, I was going to say, across the Atlantic in Europe, the debt deal done there doesn't seem to have stopped the panic. We've got alarming bond yields now, and we've got Italy, we're hearing now, is running out of cash.
Yes. So the rejoicing on the European debt deal, I think, was very, very short-lived. Having said that, bit by bit, the Europeans are being dragged, kicking and screaming, into new arrangements, which actually are helpful. I mean, they're better than the situation that we've had for the last 12 to 15 months. So, for example, the redesign of the European Financial Stability Fund, which is now allowed to recapitalize banks and which can buy, if necessary, bonds in the market. I mean, this is a long overdue innovation.
And do you think this ongoing debate about whether austerity is the right way to go in Britain and elsewhere in Europe, as opposed to the damage it might do to growth, how do you see that debate going?
Well, I think you've put the finger on the button there, because actually there is no way in which any country, particularly not when so many are involved, can actually austerity their way, as it were, towards a stable environment. You've got to have obviously cutbacks for time in public expenditure and changes in the tax regime and so on, but only in the context of trying to provide stimulus to the private sector to keep growth going. And that's something which is clearly lacking in the Eurozone at this point, also in the United States and also in the United Kingdom. So,
and we've got this issue with China as well. China is obviously the key trading partner for both Europe and the US. People talk about China as the driver of the global economy, but can it be if these two great areas are actually faltering?
Well, it could be if it didn't have such an unbalanced economy, and if the characteristics of Chinese growth weren't so biased towards investment. The investment share of China's economy is now about 50%. It cannot carry on like this. So my worry is that although the Chinese leaders speak very openly and debate rebalancing of the economy towards a more consumer society quite frequently, not much actually is happening on the ground to make this happen. So my concern is that with a leadership change coming next year, too little will be done too late, and that by 2012, 2013, China could enter a period of quite slow growth.
All this dealing in the US has come down to quite a cliffhanger. The markets got very stressed over this. Does that matter to you?
Well, it matters that financial markets get stressed at a time when there's not very much growth around. And even in the emerging countries and in Asia, for example, I mean, some of the industrial production numbers, the export numbers have been looking a little bit kind of soggy of late, even if they're coming from very high levels. But the financial turbulence is really kind of a bellwether of confidence in spending and in the outlook for incomes and profits. So even if we look in the rear-view mirror, we can see that, we've come from a kind of a bungee jump out of a terrible global slowdown and recession in the aftermath of the crisis. But we're now kind of running out of momentum. And I think what's going to happen over the rest of this year and in 2012, actually, to me, looks very, very fractious and likely to be disappointing for financial markets. And, of course, that becomes a little bit self-reinforcing.
George Magnus, it's great to hear you, if not see you. We thank you so much for joining us tonight.
Thank you.